Hello, everyone. Thanks for joining us today. This is the first uh, webinar session in 2027 financial year. We had a webinar session last month in regards to the changes of the tax reforms, and actually we had over 100 people attended our session and asked a lot of amazing questions. And thanks very much, for people joining us today. And we had about 88 people subscribed to our session today. And also, I think, people joining for the recording as well. So hopefully the information that I can provide to you today could add value to your situation. Before I get started, I wanted to make sure that everyone understand whatever I talked about today is general in nature. Everyone's situation is different, particularly in purchasing a property, building wealth. So if you wanted to have a chat with me after this session, we have our contact details here. So make sure you lock in a time. We can have a further discussion specific to your situation. So today we wanted to center around how these tax reforms is going to potentially change how we look at property investing. Since the budget came out in May, about 2 months, less than 2 months, I would say, the whole property market had a huge shift. So every weekend we look at the clearance rate, and we look at social medias and people sharing the post about the drop of the property prices. So people are actually quite confused and also concerned how the property market would potentially unfold in the future. Is it going to be further declined, or what's it going to be? Or is it going to be just a short-term pause for most people? Unfortunately, I'm not the one with the crystal ball. I can add some of my analysis, but unfortunately, I don't think I would be able to predict the future. But hopefully, whatever that I can share with you could be your reference point. Doesn't mean that you take it as the truth, okay? Feel free to ask any kind of questions. And just before I jump into it, I just want to let everyone know that I'm actually having a flu today. So if I paused and coughed, I try to mute myself and cough. So there might be a period of silence. So just bear with me for that few seconds, okay? All right, now let's jump into what we wanted to discuss today. Okay, so there are a couple of things that happened since the budget came out. So the royal assent granted on the 26th of June, 2026. So about a month ago, that got royal assent, and most the tax effects is going to start later. Obviously, some of these are already applied from 1st of July 2026, and there are some will be applied from 1st of July 2027. And obviously, everyone's talking about new build. It's actually quite interesting because when we talking about new build, I think there are some misconceptions. Today, I wanted to clear that up, making sure that we have a bit of understanding of what defines as a new build. But further details haven't actually been disclosed, so we will have more information later on down the track. So today's decision, okay, is very important. I think that's something that I want to share with every one of you. So the tax can improve a good investment, but it cannot rescue a poor property. Okay, a poor financial decision cannot be rescued. Okay, the best way is really just scrap it, starting from zero again. Admit you made a mistake and then quickly save all the cost. Avoid further mistakes or some cost throughout the process. There are 5 decisions or 5 areas that I will talk about today. So while we're going through these questions, topics, if you have any questions, feel free to pop into the chat. And by the end of it or halfway through, I will have a look at the chat room and see if there's any questions that I can address. Okay. All right, let's go to the first one. There are some of the key dates that is very important for our properties. First is 12th of May, we know when the budget came out, there's a 7:30 p.m. cutoff. The contracts before the cutoff can preserve existing negative gearing treatment. So any properties that purchased before that date will still have that negative gearing in place. So today I will go into a little bit more detail about negative gearing, because when we have multiple properties and how this can be calculated, it is actually quite interesting. So we'll try to answer these questions. As I mentioned again, on the 26th of June, we got the royal assent. We know if any tax wants to become a law, then that needs to happen. Pass through the Senate, get the royal assent. And now, yes, the negative gearing, capital gain tax, these are all tax laws. So we need to go by the laws. And quite interestingly, so this is sort of like a bomb exploded when we heard the news that the Self-Managed Super Fund limited recourse borrowing arrangement for residential properties are restricted or sort of like banned after 10th of August. So the news came out in early July. I think that's caused a bit of panicking for a lot of people because we actually have a lot of clients that planning to do self-managed super fund purchase in this new financial year, and all in a sudden, this came out of nowhere. It sort of like stopped the whole strategy being implemented. So how are we going to deal with this? Obviously, we can briefly touch on this. I don't want to spend too much time on this. We can have another session just dedicated for self-managed super fund borrowing and property investment. So 1st of July, we have a bit of time till next year, about another 12 months that we can make some adjustments. There are some loss quarantined and new capital gain rules that's going to apply. Okay, so these are the key dates that we need to be aware of. A lot of people ask me about the trust, family trust tax. From my understanding, there hasn't actually been become the tax laws. There are still things that needs to be ironed out before it becomes officially as a law that to be implemented. So when that happens, we will definitely have a session to talk about this. Okay, let's continue with this. And if you have any questions, feel free to put in the chat. So we will stop and have a look at these questions as well. Okay. So with these rules that come into effect, there are three things that we need to be very much aware of. So three property lines. The grandfather held an under contract before the budget, the capital gain is not fully grandfathered. So whatever that happened before 1st of July 2027, you're still going to benefit with that capital gain tax. And people ask me saying, look, if I purchased a home and that is a new home and I lived in there, and then, someday in the future, then it becomes an investment property, would I still have the capital gain tax? So if the home is under the new build, yes, you'll still be able to have the capital gain. It is when the ownership started, okay, so before the 1st of July 2027. Eligible new build. So genuinely as to the housing supply, that's a very interesting one, because when we look at the new build equals to adding to the housing supply. So we're going to go through these list with you guys today, so to help you understand what are categorized as a new housing supply. So negative gearing continue to be able to work with these properties. So you're still going to be able to benefit that for all these kind of amazing tax benefits. So on selling these properties, you can still have that 50% discount, or you can choose to have that indexation and the minimum 30% tax method, whichever comes out. We'll talk about more on that in the later slide. So acquired after that 12th of May, what's going to happen? So from 1st of July, excess residential rental losses are quarantined. So it's very interesting to see how this is going to work out. We will give you some examples later on about this. Because with all the words that we can gather now, this is how I think this is going to work out. But if there are changes, we'll have future sessions to talk about it. Okay, so this is the exciting slide. So what exactly is new build? I think a lot of buyer agents or selling agents are trying to get their head around this new build. We can have a look at here. The policy likely eligible. So new apartments bought off the plan, 100%, that would be considered as a new build. Home built on previous vacant land, yes. Duplex replacing on a freestanding house. See, this is adding to the supply, okay? So it's one for one, that's the difference. So new property occupied under 12 months before first to sell is also considered as a new build. Or what are not considered as a new build? So existing home with extra bedrooms added. Okay, so if you do extensions, renovations to the existing home, even though they could be massive renovations, it is not considered as a new build. Knock down and rebuild. So if you buy a big land with and you just have very old house, knock it down and build a new one, it is not considered as a new build. That's one for one. You're not adding supply to the overall property market. Granny flat you build next to your property is not considered as a new build. And obviously new property occupied over 12 months before sale to an investor is not considered as a new build. So people ask me where you get that information from. So is that just something you think out of your own mind or head? No, not necessarily. I want just to guide you to this page. Okay, so this is a document that's issued by the budget paper. It talks about the negative gearing and capital gain tax reform. So quite interesting. We'll go through the highlighted part later on for the negative gearing part. So quite interestingly, so there's a table, right? So new builds comparison table that telling us what are considered as new build. So we can see a newly constructed apartment. So basically, I got all the information here, okay? Let's look at not a new build, a freestanding house constructed through a knockdown rebuild, replacing an older, smaller freestanding house. This is not a new build, okay? So if it is a duplex or you build it into a townhouses, these are very different. So that's something that you need to be very mindful of. And granny flat is different. Don't think that a portion of your house could benefit from that negative gearing or capital gain tax discount, okay? So that's something that a lot of people are not so sure, getting a lot of questions around, but hopefully that could help us to clear up the picture. Okay. So now we have a better understanding of what is a new build. So from my point of view, if I'm sitting down with a client and the client asking me, Frank, should I buy a new build property for my investment? These are the 5 things that I would say, look, we need to have a look at these 5 areas. And each of these areas would present risk to you, okay, a specific risk to you. And how we manage these risks is very, very important. That's the reason why we also have a scorecard or checklist at a later slides that I can share with you. So feel free to screenshot on your phone. If on the computer, you can screenshot. If you need the slides, and you can contact our team as well, getting a copy of this recording. So first is demand. I want to spend a little bit of time talking about this. So the whole property market trend for the past 2 decades are built on demand. Right now, people are still talking about, okay, we have a massive shortage of housing and the demand is there. If we don't have enough house built, we're not being able to support enough people having homes. This is quite interesting because when we dig down deep to look at the data, do you see people actually living on the street? You don't. You will see that people getting kicked out because they can't afford the higher rent. But you don't see there are places where people can't find a place to live. Yes, there are very low vacancy rates, but the supply and demand is very interesting. It's like a sponge. People can actually move back to live with their parents, or they can have shared accommodation. So these are all kind of like a sponges that could massively change the demand and supply side. One thing that we need to particularly look at is the migration. Okay, so okay, forgive me. So the demand side is with the migration. So we need to really look at the immigration numbers and how many people are coming into Australia. And these are the numbers that's going to impact the future growth, future trend of this kind of demand. And when we look at the price, that is another interesting aspect that we need to figure out, because we have seen recently a lot of news coming out and talking about. I'm sorry for that. Yeah, I was just telling my son to be a little bit quiet. So yeah, with the price that's going out there, we have seen recent news talking about prefab homes, a home that can be built within 20, 30 days. So that could significantly reduce the cost of a home. So if that becomes a trend, a lot of these major developers come in to do the prefab homes and to, build a lot of homes in a relatively short period of time, that could massively reduce the cost as well. So these are the things that we need to look at, how these new homes are built and what's the trend of the future constructions. The cash flow is another important thing. It's not just about the vacancy. It's when you acquire the land from this property being completed, that's going to take time, right? So if we can shorten the time, obviously you'll have less impact on the cash flow. But if that dragged on forever, like with all the different applications and certificates that you need to get, then that's going to drag on the cash flow where you're not getting any kind of rental income. So these are the areas that we need to be particularly careful. And also with the delivery, how this could deliver to you, how long that's going to take to build, things like that. So we have seen a lot of agents are working very closely with builders and developers to package the whole project and making sure that it is delivered in a timely manner. So I think that is a future trend where an agent comes out and says, look, we're gonna have a one-stop service to you. We're gonna measure everything for you, and we're gonna deliver to you by this date. So I don't know if that's something that's already happening, but I have seen that quite a few agents are talking about this and wanting to make sure that the client comes in, they sign the contract, and they know exactly when it's going to be delivered and what the costs are. So I think these are going to be future trends if they wanted to make new build as less painful as possible. Okay, so these are the things that we need to look at before we commit to a new build. Okay, so the new build obviously brings tax advantages. I don't want to go through this in detail because anyone who's purchased the property before would know that obviously with new builds, you would have a lot less maintenance at the beginning, and you will have a really high depreciation because it's a brand new capital works. And also you have depreciation of all the appliances as well. You get negative gearing, you get the capital gain tax choices. So for high income earners to massively reduce their taxable income, new build will still be a very good solution to go for. As long as with that actually we got the pricing, we got the demand, these kind of box ticked. Okay. All right. So this is a rough calculation in terms of with the annual rental losses and how the tax benefit would be benefiting you. So I think anyone that is ever used the negative gearing would know that you would be able to massively reduce your taxable income. And it's quite interestingly because when we are actually at the very high end of the threshold, if we're able to use one or two investment properties and use the negative gearing to bring us down to the next threshold, that would actually massively save you a lot of money, including the division 293 where your income is over 250K. So for high income earners, this is still going to be a very valid strategy, tax strategy to reduce the taxable income. But obviously, when we look at a short-term taxable benefit over the long-term wealth creation, these are two very different topics. If the short-term gain is actually outweighing the long-term benefit, obviously we can have a look at the short term. But if the long-term sacrifice, just purely for the first 10 years the tax benefit, then it wouldn't be a good investment decision. So how do we go about doing that? There are a couple of things that we need to look at. First is the value of the property. Is there a lot of bubble already in this area? So how the future trend would go? We need a lot of information from the agent, especially local agent, to support our decision making to say that this would actually be a long-term growth for the assets. Okay. All right. Now, before I jump into talking about the negative gearing and quarantine losses, I wanted to have a look and see if there's any kind of questions. Okay, no, there are no questions. Okay, so what I want to do is before I jump into quarantine losses, I want just to share a little bit with the discoveries that I find with other countries when they're going through a property downturn. So recently I read a very interesting book is about mastering the market cycle, the cycle, basically the market cycle. So that's by Howard Marks. Yeah, so that I just got the book next to me. It's a very interesting read. If anyone get the opportunity to read that book, I would encourage you to have a read about it. So the everything is sort of like a swinging like a pendulum. It is impossible that we have a property market that is going upward forever. It is impossible because that is just not natural. If it goes on too high and too extreme, it's gonna bounce back with enough momentum and to last longer and go down further. So that's what we have seen from the past histories. And it is interesting because the book talks about there are two characteristics. One is people tend to forget history, okay? Because at the very hype that they think, okay, this is not going to happen to us. The property market is never going to go down. But slowly when the pendulum swing to the other side, they're starting to realize and they're getting to be more pessimistic. And this is going to have a snowballing effect where people are going to hold a long-term view that the property market is going to go down. Okay, so if you're starting to see the media, I don't think media is doing any good job other than steering the whole emotion to the wrong side. So today I opened up YouTube and look at the news and say, look, specialists say the property market is going to go down for longer, right? So this is kind of news that coming out in the media. Is that going to help us to build the confidence of the future wealth growth? No, absolutely not. So I don't know why they're doing this just to capture the headline. But what I think is important is whenever we invest in something and when something that is going to an extreme, we need to think, okay, what's going to happen if it goes to the other side? Don't tell yourself it's never going to happen. We need to ask ourselves, what are we going to do if that goes to the other side? Because that is going to be a very valid question you ask, and the answer is going to shock you most of the times. And you're going to actually start preparing, and you're not going to sit and do nothing out there. So that's something that I want to share with you, is to always think to the worst case scenario and get prepared for that. Oftentimes it might not happen. Then when you look at this and when this kind of situation happened, mentally you're well prepared. Okay, so with the quarantine losses, how the negative gearing is going to work in the future? Obviously, we're not going to have negative gearing, and most often we're gonna have this word quarantine losses. I just want to go back to this budget paper because I think going back to the source is very important. I'm just going to read this together with you so you know what this is about. From 1st of July 2027, losses related to existing residential investment properties purchased from this particular date, time, will only be deductible against other incomes from residential properties, including capital gains. However, when an investor has excess losses, they will be able to carry forward that excess to offset residential property income in future years, enabling losses to be carried forward, ensuring investors remain able to claim a deduction in the future for costs such as maintenance. So these changes will apply to individuals, partnerships, companies, and most trusts. This is a very important text, and for some people that reading this is very painful. So allow me to sort of like break it down and talk through what this means really. So only deductibles against the income from residential property, income from residential properties. So what that means is, if you have one property that is losing money and you have another property that is making money, potentially they can offset each other. put it in another way, okay? Because they look at everything that you own in that specific ownership. Say, for example, you as an individual own 100% of two investment properties. So all the rental incomes that can be used to offset whichever property that has these kind of quarantined losses over the previous years. So that makes the whole picture a lot clearer. So if, say, in a scenario where we have one client, very high income earner, having a property, maybe sold one investment property and paid down the debt, and now there's not much of a debt in there, and there's so much income, rental income coming in, and it's not very tax effective. What can we do? Obviously, buying another investment property with a loss that to offset the income, that would help. Even though there might not be negative gearing effect, that would actually reduce whatever that income that is positive income generated by the first property. So you see, not necessarily we need to have the negative gearing. We can still help this particular client to reduce their taxable income. So simply by reading this, we understand that there are strategies that can be played out in a specific situation, in a particular situation. So look at this. When an investor has an excess loss, they will be able to carry forward that excess to offset residential income in future years. And it is very important to ask us, what exactly are losses? Are these like, you pay the interest, and you pay the council rates, but obviously the rent is not enough to cover everything. What about depreciation? Can that be claimed as well? So most people know that for depreciation, there are division 40 and division 43. So basically, put it in the plain language, in the house, you can depreciate the brick and mortar. You can depreciate the appliances like the oven or wrench hood that you wanted to do. But these are in the two separate categories. These we call the paper loss because you don't see the wear and tear, so you don't actually see that money goes out, but you see things are slowly degrading. So these are actually losses can be used as well, together with the interest expenses added together as losses to offset incomes from, property incomes from other properties. And it also can be carried into the future. So that means maybe in the future when the debt reduced to a certain amount, you're starting to have a lot of positive income coming in, it can be used to offset it. And if you don't, and by the time that you sell it, you have some capital gains, that can be used to offset your net capital gains. So it's not going to go anywhere. It's going to be trapped in there and recorded and basically carried with you till the end. So in thinking like that, it is not an entire loss because we just can't use the negative gearing to have the short-term immediate joy, but we're still going to have whatever the loss that is there to carry it forward to the future years to offset the tax that we need to pay in the future. These are pretty neat. So I don't think we need to be particularly, pessimistic on how removing the negative gearing is going to change how we really look at investing. But instead, we just know that we're not going to have this immediate hits of, tax benefit. And if we wanted to have that, of course, we can look at new builds as well. Okay. So this is basically what we're talking about. From year one and next year, so we can offset future residential rental profit, and on sale that can be used against all the capital gains. Yes, it can be used for other capital gains. So if you have two investment properties, can you use that to offset the losses? I don't see why not, because they're all calculated at the same time. We will have more guidelines in the future, and obviously we'll revisit this when it comes, okay? So hopefully that helps us to understand better what are the quarantine losses. Okay, capital gain tax after 1st of July 2027. Yes, so we're going back to 1999. So anyone that remember the old days, before 1985, the capital gain tax introduced to us, and also there's a transition period where the indexing method was used. So yeah, looks like there's not a lot of innovation here, but adding an extra 30% minimum tax to it. So the new build will still be able to benefit the 50% discount and obviously the indexation plus 30% minimum tax. So I think we talked about this in a great length in our last webinar. But I just wanted to recap of what exactly this is about. So the index cost base in the pre-99 asset, generally there's a list, okay? So in what month, what year, they have an index score. Let's say it's 1.1, and that's the date that you purchased. And then you sold in this month, this year, there's another like 1.8. So using 1.8 divided by 1.9, 1.1, then you get the ratio where you can index the cost base. Then you compare with the 30% minimum tax to see whichever is higher. Obviously, they would have to look at the higher one, isn't it? So extra can apply if the ordinary tax on the real gain is below 30%. All right, that gives us a pretty clear indication that if you have a new build, you'll be able to benefit more on the tax discount. So let's have a look at this. This is basically saying, we don't really need to drill into all the numbers, but I just want to tell you the summary is 50% discount definitely will win in most of the situations. But in what situation the 50% discount is not that favorable is when the inflation is really, really high. So if we have a very high indexation numbers, then the difference is going to be minimal. But in the end, I don't think that we're going to have the high inflation for really, really long time. So if the high inflation isn't there, then obviously the 50% discount will still win in most of these situations. Okay, now a lot of people ask me, Frank, who should I choose for the next property? What can we do about this? Okay, so it's quite interesting because a lot of things would change, including the trust. Individuals looks like these will always be the simpler and easiest to pick first. Obviously, you can carry the loss with yourself for the investment properties, and also offset the future gains eventually when you starting to have positive income or when you sell the properties and having a capital gain. But obviously, you have a lot of exposures, from land tax, estate planning, asset so like succession. So a lot of things that we need to consider, and also including like marriage breakdowns and things like that. So these are, yes, simple yet more problematic if things go wrong. Okay. So discretionary trust is commonly that we use that as a family trust. So the losses are always stayed in the trust, right? So if you purchase an investment property and that has a loss, it is trapped in there. Okay. And there are much more flexible distributions for sure. But guess what? The proposed 30% minimum trust tax and the potential removal of bucket company that made this pretty much I would say, the worst structure in the future to purchase in a property. A lot of people are starting to consider fixed unit trust, and they think that would potentially help solve the problem. Yes, to a certain extent, but that is another conversation that we can have or topic that we can have in detail in future sessions of our webinars. Because obviously we're talking in very broad terms today. We want to go into detail in the future for specific topics. Company, would that be a good solution to buy a property? Yes and no. So oftentimes when people choose companies, there are some considerations around borrowing, because company might be able to allow them to borrow a bit more. So these are very different. No individual 50% discount, that is another thing, because if you buy new in individual terms, you can have the 50% discount. So it is also very property specific. And especially when you get a company involved, I think there's a lot of talks around actively trading company holding investment assets. That's going to be another topic that we can talk about when we have the opportunity to go through this in detail. Is because obviously when the family trust came out, I remember in our last session, we also went through the budget paper. it has quite a few paragraphs talking about why using bucket company and removing the bucket company, and also why considering adding, incentives for active trading companies to hold investment assets. A whole lot of things that are happening. There might be an opportunities there that for people that owning their business through a company. Okay, we're going to talk about that more later on. So stay tuned for our webinars. We want to have monthly sessions to talk about, the questions that you have in your mind and, topics that everyone's interested. And if you have more questions, feel free to pop into the chat. So self-managed super fund, is it going to be a good ownership? So we all know that from 10th of August, we're unable to purchase residential properties, but commercial properties are still on the table. That is an option for us to use. So in this kind of situation, people say, okay, what if I really wanted to buy a residential property? I think a lot of smart accountants already figured out ways, say, for example, using unit trust to partner up with yourself, and then using leverage outside of self-managed super fund to purchase investment properties, or just buy it outright. So there are ways to potentially go around this. But one thing that I want to ask to a lot of people is, if self-managed super fund eventually is going to be a whole lot of hassle for you to eventually purchase the property, then what's it going to do to the residential property market? I think that's going to cool down quite a bit. For people that's already invested into properties, I think they are the actual beneficiaries. These properties were really cheap, rents are really high. They're not really worried about, the cash flow and stuff. So it doesn't matter what the property value is going to be, they still have rent to basically pay it down. So these are the things that I think that's going to be pretty interesting to observe in the next 6 to 12 months, and see how other professionals are looking at self-managed super fund and, all the strategies that comes out. All right. Okay, now we talked about a lot today, specifically about the negative gearing, self-managed super fund, or the changes that's happening here. Let's talk about the debt strategy. Okay, so before you buy, there are a couple of things that I wanted to, my observation is to see that there are definitely going to be rate rises. And is it going to be 2 or 3? My prediction is going to be minimum 0.5% increase in the rate. And well, obviously we need to closely watch the unemployment rate and how things is going to evolve in the next 6 months. But I think rising, increasing interest rate, that is definitely possible. And how that's going to impact future investment, you're going to have to really test your stress, okay, mortgage stress, and adding the extra rate to see how that's going to impact your repayment. And always have a bit of cash buffer to go through this period of time, okay? So discuss that with your mortgage broker. We have a fantastic mortgage team that would allow us to have that kind of conversation with you to understand what are the options available there. So make sure you understand all the options and possible before you do anything. So we have seen in the past a lot of people actually getting a pre-approval and then going to the property market. That is constantly changing. So whenever there are things changing, for example, like a removal of negative gearing, whatever the pre-approval that's getting might not be still valid. And by the time of settlement, there's not enough to settle. And the value could be different to the contract price. So these are all the things that could potentially impact the final settlement. So please, keep direct line with your mortgage broker. Stay at the very forefront of all the changes. Okay. So another people ask me and say, look, should I refinance my property and get the money out and continue to buy properties down the track? That is a very specific question. So continue to build property portfolio. Is it a good strategy? Yes and no. The reason why I say yes is, if you, obviously the buyer agent can justify what I said. So if you observe, even in Canada, right? So I spend a lot of time looking at the Canadian property market. Even in Canada, when there's a massive corrections, there are still areas where it's continue to grow. So the property market is very much similar compared to Canada. In Australia, where there are always pockets of areas that will continue to grow. And these are the areas where really good agents will help you to discover and help you to secure these properties. And you'll still be able to make money in these areas. Because when everyone is worried and feared that the market is going to crash, these things are going to go lower, these are exactly the time where opportunities will arise. So I think that's, for me as an investor, not just property, I do a lot of other investment, is I look at the broader sentiment of how people view their investments, especially when 80% of people are worried that you're going to be that 20%. Okay, when 80% are, we call it like euphoria, when people are so excited about what they need to do, that's exactly the time that you need to pause and reconsider, okay? Because a lot of things could be blind at the time. All right, so with the self-managed super fund 10th of August, we don't have a lot of time left for that. Maybe, less than 2 weeks time, 12 days. So yes, before 10th of August, there are still opportunities to get that done. I personally don't want to do that. There are clients that are asking me to help them do it. I said, look, it's just so hard to do. And there are a lot of compliance issues in doing that. And potentially we're just, burying a lot of hidden bombs that could explode at a later stage. So obviously you need to see what can continue. Borrowing arrangement entered before the commencement, qualifying refinance or pre-commencement borrowing, borrowing tied to an acquisition arrangement entered before commencement if settlement is later. So that means, you exchange the contract, settlement can be later. So after the commencement, borrowing for qualified real business, so commercial only after 10th of August to if you wanted to borrow money against that specific property. Okay, so if you want to buy outright, no problem. Residential property without borrowing, and the investment satisfies the super law. New residential property borrowing is generally unavailable. So I cannot imagine how these lenders are going to react to this. That's sort of like their lifeline to lend to self-managed super fund buying properties. Now they can only do commercial loans. So in saying that, if their books are going to massively shrink or not expanding, then obviously if they wanted to get more out of it, then likely that self-managed super fund borrowing cost is going to increase, because the borrowing cost, or we call it the credit cost, is directly associated with how much we can expand the credit. If we cannot expand the credit, the cost of it doing business is going to get higher and higher. So which is bad news for people that still wanted to borrow money using self-managed super fund. They're gonna have to really look at something that is with really high income yield and borrow maybe only 50%, 40% to make sure that the cash flow still makes sense. So it's gonna be done much more conservatively, and also it has to be done on a case-by-case basis. We have seen a lot of success around people that buying the property for their own business, for example, like a general practitioner, dentist buying their own practice, and then lease it to the business. There's nothing to worry about. The rents, the vacancies. These are really good business. So if you have business that potentially that would require a commercial property, that is an opportunity to look at, and I strongly advise at least explore that kind of opportunities. Okay. All right. So here are some of the plan tick boxes that I hope that to share with you and making sure that you don't get into all these kind of troubles. So with the contract, obviously you need to look at quite a few of these dates, and with the developers, right? So I can foresee that there are gonna be some um, some issues with the smaller developer where they cannot really support themselves with their enough cash flow. So strong track record, and also finance, get the pre-approval, making sure that it's still valid, getting all the inspections done, making sure you keep a good record. These are all like a common sense, but you'll be surprised when we're starting to look at these issues and say, oh, I forgot to save this. Oh, I forgot to check that. So it is worth to keep it as a to-do list and making sure that yes, I've done this. Yes, I've done that. Yes, that's all in place. Okay. So buying off the plan is not entirely a bad thing. Like a lot of people asking me, should I still consider off the plan? So obviously with the construction, the quality of the construction is improving. Obviously in the past we had a lot of issues, but now we can see that there are much more stricter rules that put in place. And also, if you buy from a reputable developer, obviously you can have a certain level of guarantee of the build quality as well. Besides, you need to look at the suburbs. Is it a growing suburbs, or the facilities are in there, how the future traffic is going to look like, things like that. So off the plan would allow you to own a home much more quicker, faster, and you will be able to spend a lot less um, to the homes comparing to owning a house. But people say, look, will the off the plan increase in value of the long term? That is a big question. I don't know, because be honest, with off the plans, it has a different cycle comparing to the houses. Um, Definitely to a certain point, it will grow. The reason why I say that is we need to look at the fundamental valuation of an asset. If we purchase an off-the-plan property, let's say it cost us only 800K, right? And the rent, let's say, is 950 in a prime location. Look at this. If we're using it as sort of like a yield return, the value is actually making a lot of sense comparing to a $2 million home only rented out for $1,000, right? So everything that we will look at, eventually that will go down to how much cash flow you would be able to generate. So to a certain level, a certain extent, it will increase in value. But would that be massive? I don't know. So it might be a good investment for cash flow purposes. Okay. A lot of things that I wouldn't know, but hopefully I would be able to share some insight with you in our future sessions. Here is a scorecard that I think that is very, very important before you look at some of these investment property purchasing, especially tax benefit that you wanted to get. So first is obviously demand. We wanted to look at the vacancy rates. We wanted to look at the price, and that's sort of where the buyer agent can step in to help to evaluate if it is a fair price to pay. You're not paying too much for this particular property just because you really liked it. And what are the rates around this property that you also need to be aware of. How the finance and defects are managed, and also uh, the eligibility for the tax. So is it going to be um, for negative gearing, for capital gain tax discount, things like that. So you need to be very much aware of before you jump into that decision. Okay. All right. So what can we do in the next 3 months? I think that is actually quite interesting. Should we continue to look for properties, or should we just, pause and do nothing about this? I think it really depends, because I believe a lot of people say, look, we're just going to wait for 6 months and see what's going to happen. I think that's pretty valid. So you wanted to see how things are going to evolve over time. But in saying that, I would say um, whenever that you see the value on the market, right? So if you go into realestate.com and see the property is $1.1 million, not necessarily that's $1.1 million, because when you actually go there, you might get it for 900. So you can still to look for a really good valued property. The key is you need to have a good relationship with the local agent. I think that is very, very important. I remember you and from Morton shared the stories with us in one of our sessions about the properties that eventually got settled. I think that just represents what the market is expecting. The buyers, you wanted to get a home, you want to get the right investment, you're going to get it at the right price. So have a really good relationship with the local agents. That is very important, and they will be able to help you spot really good opportunities out there. because they've been in this neighborhood for so long. This look, this is never gonna drop below $2 million, and that 1.8, that's gonna be a steal. If you don't get it, I don't think when you're gonna get it. So yeah, these kind of conversation I think is still worth to have. I think a lot of things are happening too fast before people can comprehend. Is it gonna be a massive drop for another 30, 40%? I don't think so. I don't think that could happen in the Australian property market unless they're gonna have all the robots start building all the houses and it's gonna, pump out like a factory with all the, houses that done in 10, 20 days. I don't think that's gonna happen immediately. Okay. And also for some areas, especially in Sydney, it's very hard to build new buildings, as you could imagine. That the building laws are just so hard. So yeah, everywhere is different. So don't use this for your own local area, but to think differently. Okay, map out the property, do a stress test, and obviously decide with all the checklists that you have in your mind. Now, we got some questions as well from when people registered and raised here. So can I still buy an established property? Yes, for sure. If the cash flow makes sense to you. Is every off-the-plan property a new build? Not necessarily. A policy examples help, but eligibility must meet the final legal requirements and be evidenced. Okay, so not all the off-the-plan. Should I move my property out of a family trust? So there are some changes, obviously, to the family trust. Is it going to be like a rollover relief? You don't need to pay capital gain tax. Do you need to pay stamp duty, etc.? Because we have heard a lot of people talking about, should we just remove stamp duty entirely? In maybe Queensland or New South Wales. I think that could be a trend in the future. They're paying like an installment. And if that becomes a trend, then the whole thing might change with the cost of moving assets out of the family trust. But if we look at that, asset protection, distribution of wealth, these are different conversations, not just purely about tax, right? So we have to do this carefully if you wanted to move anything in or out of family trust. So self-managed super fund can still buy residential property, just not through borrowing against that particular property. Okay. All right. So I have answered all these questions, and I can see there are about 34 people stayed on the line, continue throughout the whole process. I don't know if you got any other questions for me. Feel free to pop in to the chat. While you're doing that, there are a couple of things that I want to share with you, and I think that is very, very important. So you can simply screenshot this page, which is this link, tools.exionwealth.com.au. I want to show you how amazing this is, because I have been thinking about this and for a long time, and I said, look, a lot of people are asking me these kind of questions and how we can really help them. Okay, so I'm going to share that with you. We have built 9 different calculators. Okay, so you can play around with these calculators. I want to share some of this with you, and if you're interested, please play around with these calculators, and you can even share that with your clients as well. So self-managed super fund buying a property. This is actually designed way ahead of the ban happened, but it still helped us to understand if we wanted to buy a commercial property. So we can put in the purchase price, we can put in the interest rate, loan amount, we can put in our salary, how much we can contribute, and then we run a projection. We can see what the cash flow is like. When can we achieve a positive cash flow? What the future growth is like. So we can actually see all the details here to help you make a better financial decision with this kind of modeling. You can save that neatly and then change some features or some numbers, and then just back and forth compare with all the different details and see what's going to be a better outcome. Because some people say, look, if we can increase the yield, what's it going to be, right? And you can also email yourself this report if you want to. Okay, so not just for self-managed super fund property, we also have one for investment property. So we have actually heard a lot from clients and say, look, we worked with a lot of agents, but we find out their calculators are pretty limited to realistically represent what is actually happening here. So that's exactly what we're trying to do. Okay, so we can actually put in all the details, including the strata fees, land tax, and also insurances, council rates, and all that, all the expenses that associated with the property. And also you can have your depreciation added in there. You can add a different inflation rates for expenses. You can change your marginal tax rate to see what exactly is going to be the tax benefit for you. Obviously, as I said today, for new builds, you will be able to have all the tax benefits in there. If it is not a new build, unfortunately, that's just going to be carried over. Okay, so in the future, we might be able to have the quarantine losses, as well in this calculator. So it's constantly evolving. Same for tax. So a lot of people are not quite sure how much tax that they need to pay, the benefits that they can have if they put a little bit more into superannuation. They can do that. Mortgage calculator. This is probably by far the best that I think I really enjoyed making. Is we had the offset and an extra payment. Because people say, oh, should I put the money in my offset account or should I put the money into my super fund? We have a lot of questions like that. And we'll say, look, if we put, let's say, 200K in your offset account, and guess what? We're not just saving the first, let's say we have 5 years, put it in for 5 years, right? We're not just saving the first 5 years interest, we're also reducing the time that you can fully clear the mortgage. And that is also interest saved over the time. So how much you can save. So that gives the client visually how early they can pay off the mortgage by leaving the money in the offset account. So that has a different perspective, especially when we get asked with these kind of questions. So a lot of people say, look, Frank, why are you putting these calculators online for free? Because I think, if you know how to play around with this and then you need my help, you would definitely naturally go to the page and look for my contact, right? So we have some investment growth calculator as well. One more thing that is very important for a lot of our clients is how much money do I need to retire? So if I retire in 10 years, my cost of living is this. With my asset and income, would that allow me to retire? Unfortunately, for a situation like this is no, okay? All right. There's a lot more that you can explore. I would encourage you to screenshot this page and take a little bit of time to play around with this, and you can send the details to you. So if you want our team to contact you, you can simply tick and say, look, please give us a call. Our team will contact you within 24 hours. So a lot of people ask me, Frank, what are your services? How you help clients? Guess what? It's all here in our services. So you can see our service proposal. So I can explain how the whole thing work out for you. So all our client comes in with our financial planning session. Okay, so this session will have about 60 minutes to go through your situation with you and to understand the direction that we need to go for. And eventually we will create a report for you for our planning session. So that would provide you with a summary of what we should do in the next 10-20 years. And with that, if you decided to say, look, Frank, I wanted to take up the service called financial wellness service. I wanted to do service like tailored investment solution. You get credits for the service packages here because we have a lot of clients that come into us, wanting to do education bond services. And it's quite interesting. So if you have young kids, we have an education planner here. You can put in all the expenses and it will be indexed for you. So you can plan all the education costs. And you'll be surprised, we're actually, the leading firms are helping the younger families to plan for kids' education. So we have a team that actually managing different areas for our clients throughout the entire journey. Okay. So thanks very much for the time today. Yeah, so I think we managed the time pretty well for the entire 60 minutes. And I managed not to cough too much and, shout at my kids to just stay quiet. And if you have any more questions, let me have a look. Q&A. Okay, for existing investment properties, do we need to do property valuation? Yes. So on the 1st of July 2027, make sure that you do an evaluation with a proper valuer, and that 50% discount will be applicable till 1st of July 2027. So if you purchased like 2 years ago, like from 2 years till 1st of July 2027, you're still going to benefit that 50% discount. Then from 1st of July 2027, with the valuation going forward, you're going to use the index method to calculate the capital gain. Okay. Yes, the recording will be available to you. All of you subscribed will have the team send out the recordings. I will aim to put that on my YouTube channel as well. So hopefully we can have a more consistent webinar. As you can imagine, it's a lot of work to put in there to present all these kind of information. And thanks everyone for your support as well. If you have any more questions along the way, feel free to email us, contact our team. We'll be more than happy to support you throughout the entire journey. All right, so without taking more time from you guys, thanks very much for today. Enjoy your evening. Bye.